Ever wished you could pay for medical expenses with pre-tax dollars
Ooh.
and then watch those funds grow through investments?
Like magic, right?
Like magic.
Yeah.
That's an HSA, a health savings account.
That's right.
Today we're diving into HSAs.
Awesome.
And their close relative, the IRA or individual retirement account.
Yeah, IRAs.
We've got 2 articles from the Motley Fool breaking it all down, focusing on those 2024 and 2025 rules.
Really important stuff.
So whether you're prepping for open enrollment, or maybe you're considering a high-deductible health plan, or maybe you just want to become a saving superhero,
Yeah.
this deep dive is for you.
Absolutely. It's all about making that money work harder for you, both for your health care now and your future finances in retirement.
Okay, let's unpack this, starting with HSAs.
Okay.
I think most people hear savings account and their eyes glaze over.
Yeah.
But HSAs are way more exciting than just your average savings account.
Oh, absolutely. What's fascinating here is the triple tax advantage.
Okay.
So first, you contribute pre-tax dollars, which could lower your taxable income now.
Okay.
Second, that money grows tax deferred. So that means you're not taxed on those earnings until you withdraw them, potentially decades later.
Wow.
And third, if you use the money for qualified medical expenses,
Yeah.
those withdrawals are completely tax-free at any age.
Oh, so it's like a supercharged savings account.
It is.
The tax benefits on top of tax benefits.
Exactly.
I'm already seeing dollar signs.
I love it.
But there's a catch, right? You need a high-deductible health plan.
That's right. You need to have an HDHP.
Right.
And every year, the IRS sets minimums for both the deductible and the out-of-pocket maximum.
Okay.
And these usually go up a bit each year to keep pace with healthcare costs.
Right.
You can always find the most up-to-date figures on the IRS website, but the general idea is that your plan needs to meet those minimums to qualify.
Got it. So it's worth checking those numbers if I'm considering an HDHP.
Exactly.
But let's say I do qualify for
yeah.
an HSA.
Yeah.
Can I just stash cash in there? Or is there more to it?
Here's where it gets really interesting. You can actually invest your HSA funds just like you would with a 401k or other retirement accounts.
Wait, really?
Yeah.
I had no idea.
It's pretty cool.
So my money isn't just sitting there?
Nope.
It has the potential to grow even faster.
Exactly. And remember that growth is tax deferred, so you're not paying taxes on those gains year after year.
Right.
And if you use the money for those medical expenses, you'll never pay taxes on those earnings.
Wow.
The Motley Fool even calls it the only account that lets you invest pre-tax earned returns and withdraw tax-free for healthcare needs.
Okay. That is a powerful combination.
It is.
I'm starting to understand why people get so excited about HSAs.
Yeah.
But I've also heard about FSA's flexible spending accounts.
Right?
They also use pre-tax dollars for medical expenses. So how do they compare?
That's a common point of confusion.
Yeah.
They both offer that pre-tax benefit. But that's where the similarities end. Think of an FSA like a short-term savings tool for predictable medical expenses that you'll have within the year.
Okay.
So you contribute pre-tax dollars,
Right.
but those funds generally don't roll over year to year. It's that dreaded use it or lose it rule.
Right, right.
HSAs, on the other hand, are designed for the long haul.
Okay.
They're investment accounts. The funds roll over indefinitely.
Yeah.
And you can even take them with you if you change jobs.
So it sounds like HSAs offer more flexibility
Yeah.
and long-term potential.
Yeah.
Well, FSAs are more for those immediate known expenses.
Exactly.
Is there ever a reason to choose an FSA over an HSA?
If you have a qualifying HDHP,
Right.
an HSA usually wins out.
Right.
FSAs are sometimes available even if you don't have an HDHP.
Right.
Plus, they can be a good option for covering those predictable expenses like copays or eyeglasses.
Okay, that clarifies things.
Mhm.
So HSAs seem like the clear winner for anyone with an HDHP who wants to maximize their savings and potentially invest for the future. Now, how about those IRAs? I know they're for retirement, but where do they fit into all of this?
IRAs are fantastic tools for retirement savings, and anyone with earned income can open one even if you have an employer-sponsored plan.
Okay.
They offer different tax advantages depending on the type you choose.
Okay.
We'll focus on the 2 most common, traditional and Roth.
Perfect. Let's break them down.
Ah.
I always get a bit confused by the difference.
With a traditional IRA, your contributions are made with pre-tax dollars, which may be deductible on your taxes, meaning you could owe less in taxes now.
Okay.
However, you will pay taxes on your withdrawals in retirement.
I'm starting to see a pattern here. Pay taxes now or pay taxes later.
Yeah, pretty much.
So is a traditional IRA always the better choice if I can deduct contributions?
Not necessarily. Remember, the goal is to minimize your tax burden over your lifetime.
Right.
If you're early in your career and you expect to be in a higher tax bracket later, A Roth IRA might actually be a smarter move.
Wait, remind me how Roth IRAs work again.
With a Roth IRA, you contribute after tax dollars, so there's no immediate tax deduction.
Okay.
However, your withdrawals in retirement are completely tax-free. It's like planting a seed that grows into a beautiful tax-free tree.
I love that analogy.
Right.
So if I think I'll be earning more and paying a higher tax rate in the future, a Roth IRA could help me avoid a bigger tax bite down the road.
Exactly.
Okay.
And Roth IRAs have another potential benefit. They can sometimes help you avoid taxes on Social Security benefits, and retirement distributions from Roth IRAs don't count towards the income thresholds that can trigger those taxes.
Interesting. I didn't know that.
Yeah, that's good stuff.
So choosing between a traditional and Roth IRA really boils down to my individual circumstances and how I think my tax situation will change over time.
Yeah.
It's not just about saving. It's about saving strategically.
You're getting it.
Okay.
And remember, contribution limits for both traditional and Roth IRAs tend to increase slightly each year. You can check the IRS website for the most up-to-date figures. But the key takeaway is that they offer a valuable way to consistently save for retirement, regardless of your income level.
This is already making me rethink my saving strategy.
Good.
But before we dive deeper into IRAs, let's circle back to HSAs.
Okay.
You mentioned eligibility is tied to having an HDHP.
Mm-hmm.
But are there any other requirements or limitations I should know about?
That's a great question. Let's break down those specifics and make sure you have all the information you need to determine if an HSA is the right fit for you. So we've established that having that high deductible health plan is the key to unlocking the HSA.
Yep.
But it's not just any high deductible.
Right.
Your plan has to meet those specific IRS minimums we talked about.
Okay.
And you can't have other health coverage that doesn't meet HDHP requirements.
Okay, so no double dipping with other plans. It
Yeah.
really is all about that HDHP.
Exactly. What if I have an HSA and then I become eligible for Medicare?
Oh, good question.
Can I still contribute?
So you actually can't contribute to an HSA once you're enrolled in Medicare.
It's one or the other.
Got it. Good to know.
Yeah.
So let's say I'm rocking that HDHP
Okay.
and ready to open an HSA.
Great.
What are the contribution limits?
Uh-huh.
And do they change every year, like those HDHP minimums?
You're on a roll with those questions.
Okay.
Yes. The HSA contribution limits are also adjusted annually
Okay.
for 2024.
Okay.
It's $4,150 for self-only coverage
Okay.
and $8,300 for family coverage.
Okay.
And for those 55 and older, there's an extra catch-up contribution of $1,000.
Okay, so it's not a huge difference each year,
Right.
but it's definitely worth checking the latest figures.
Absolutely.
Now, what about employer contributions?
Uh-huh.
Do those count toward my limit?
Absolutely. If your employer is contributing to your HSA,
Okay.
that amount is included in your overall annual limit.
Okay.
So let's say you have family coverage and your employer generously chips in $2,000. That means you can only contribute an additional $6,300 yourself to reach that $8,300 limit for 2024.
Okay, so it's a combined effort.
Right.
And those limits apply to all my HSAs, right?
Yeah.
I can't just open a bunch of accounts
Right.
and max them all out separately.
That's correct. The limits are for your total contributions across all HSAs.
Okay.
And while you can have multiple HSAs,
Right.
it's often simpler to stick with one to avoid any confusion come tax time.
Good point. I like keeping things simple.
Me too.
Now let's shift gears back to those IRAs.
Okay.
We covered the basics of traditional and Roth,
Uh-huh.
but are there any hidden gotchas or things I should be extra careful about?
It's always wise to be aware of those nuances.
Yeah.
One thing to keep in mind with traditional IRAs is that the deductibility of your contributions can be affected by your income.
Oh.
It's called a phase out,
Okay.
which basically means that if you earn above a certain amount, the tax deduction you get for your IRA contributions starts to decrease.
So it's not always a guaranteed deduction.
It's not.
That makes sense. Are there similar income limitations for Roth IRAs?
Yes, there are with Roth IRAs. If your income exceeds a certain limit, you're not eligible to contribute the full amount.
Okay.
These income limits are also adjusted annually, so it's best to check those IRS guidelines.
Okay, so it's worth double checking those income limits
Yeah.
for both traditional and Roth IRAs
Uh-huh.
to make sure I'm making the most of my contributions.
For sure.
Now, I've heard that you can actually borrow from your IRA in certain situations. Is that true?
It is true.
Right.
While it's generally not recommended to dip into your retirement savings before you actually retire,
Right.
There are some exceptions where you might be able to borrow from your IRA without facing penalties.
Okay.
These exceptions usually include things like buying a first home,
Oh,
covering higher education expenses, or dealing with certain medical hardships.
so it's good to know that safety net exists,
Right.
but I imagine there are strict rules around it.
Absolutely. There are usually limits on how much you can borrow, and you'll have to repay the loan within a specific time frame, typically 5 years. Plus, if you don't repay it on time, you could get hit with taxes and penalties,
Right.
which would defeat the purpose of saving in the first place.
Yikes. Definitely not something to take lightly.
No.
It seems like the general rule of thumb is to let those retirement funds grow undisturbed as much as possible.
Exactly. The power of compound growth over time is incredible.
For sure.
Now, before we wrap up, I want to circle back to something we touched on earlier.
Okay.
The importance of choosing the right accounts that align with your specific circumstances and goals.
Right. We've talked about the tax benefits and some of the nuances,
Hmm.
but how can I figure out which combination of HSAs and IRAs will help me reach my financial goals?
Let's delve into some strategic considerations
Okay.
and explore how these accounts can work together
Okay.
to create a robust financial plan for both your healthcare and retirement needs.
So we've covered a ton of ground on HSAs and IRAs, from eligibility and contribution limits to the tax advantages, and even some potential pitfalls. I'm starting to see how these accounts could be powerful tools for both my healthcare and retirement savings.
That's the exciting part. It's not just about saving, it's about saving strategically.
Right.
And one thing I find fascinating about HSAs is their potential as a long-term investment vehicle.
Oh, tell me more. I tend to think of HSAs for current medical expenses,
Right.
not necessarily for long-term growth.
It's all thanks to that triple tax advantage we talked about. If you're fortunate enough to cover your current medical costs out of pocket,
Right.
you can let those HSA funds grow untouched. And because the growth is tax deferred and withdrawals for qualified medical expenses are tax free, the compounding over time can be remarkable.
So it's like a secret weapon for building wealth, especially with healthcare costs rising as we get older. It's almost like having a healthcare-focused retirement fund.
That's a great way to think about it. And even if you don't end up needing all of those funds for healthcare and retirement after age 65, you can withdraw money from your HSA for any reason and only pay ordinary income tax, just like with a traditional IRA, no more 20% penalty.
Okay, so it's a win-win situation either way.
Right.
Either I'm using those funds tax-free for healthcare or letting them grow for retirement.
Yep.
HSAs are definitely moving up my list of financial priorities, but I'm also realizing there's no one right answer when it comes to choosing between HSAs, traditional IRAs, Roth IRAs.
Right.
It's all about my individual needs and goals.
You're hitting the nail on the head. There's no magic formula. Take the time to consider your current income, your projected income in retirement, your healthcare needs, your risk tolerance. All of those factors play a role.
It can feel a bit overwhelming, honestly. Where do I even begin?
Start by asking yourself some key questions. Do you anticipate being in a higher tax bracket in retirement? If so, a Roth IRA might be the way to go. Are you comfortable with a high deductible health plan? If so, an HSA could be a fantastic addition to your savings strategy.
Right.
And remember, you can have both an HSA and an IRA.
Right.
And they can work beautifully together to cover both your healthcare and retirement needs.
Okay, that makes me feel a bit more empowered. It's about creating a personalized plan that fits my life, not just following a generic checklist.
Exactly. And don't forget, the rules and regulations around these accounts can change from year to year, so it's crucial to stay informed. Check the IRS website, talk to your employer about benefits, and consider consulting with a financial advisor if you need guidance.
That's great advice. Knowledge is power, especially when it comes to finances.
For sure.
But all this talk about maximizing savings and strategizing for retirement, it's easy to get caught up in the numbers and forget about the bigger picture.
You bring up a really important point. It's not just about accumulating wealth. It's about what that wealth enables you to do.
Exactly. Yeah. I think there's a psychological aspect to all of this, too. Knowing I have dedicated funds for healthcare and retirement takes a weight off my shoulders.
Absolutely. It's about peace of mind, knowing you're prepared for the future, and can focus on living your life to the fullest. It's about financial well-being in a holistic sense, encompassing not just your bank account, but also your emotional and mental well-being.
That's a beautiful way to put it. So as we wrap up this deep dive, I want to encourage our listeners to think beyond just the dollars and cents. Consider how these accounts can contribute to your overall sense of security and well-being. How can they empower you to live a more fulfilling life, both now and in the future? That's something worth reflecting on.
I couldn't agree more. It's about aligning your financial choices with your values and aspirations, creating a sense of harmony and purpose in your financial journey.
Well said. I think we've covered a lot of ground today, from the nitty-gritty details to the bigger picture. To our amazing listeners, thank you for joining us on this exploration of HSAs and IRAs. We hope you feel empowered to take control of your finances and create a future filled with both financial security and personal fulfillment. Until next time, keep diving deep.